Hey everybody, welcome back to another dividend investing video. I am Nick and this is the Dividend Growth Income channel. Collecting dividends for passive income is what we're all about, and even better is when that passive income grows year over year. If that's your thing, please smash that like and subscribe. Today I want to look at 3 high-quality companies that have just raised their dividend here in the beginning of October in 2022. And just a heads up, I am not a financial advisor or guru. This is not financial advice. Investing in the stock market is risky, so always do your own due diligence. I'm not suggesting we want to go out and buy these companies today. The goal here is to provide what I hope to be useful information on these quality dividend growth stocks for potential inclusion to your watch list. These companies are all appealing to own, but remember that price is what you pay, value is what you get. So let's get to it. The first company is Honeywell, ticker HON. Honeywell announced their dividend hike on September 30th, 2022 to the tune of 5.1%. Honeywell International Inc. is an American multinational conglomerate headquartered in North Carolina and were founded in 1906. It operates in the aerospace, building technologies, chemicals, healthcare, industrial manufacturing, retail, safety, and supply chain industries. Honeywell is listed on the NASDAQ and is a component of the Dow Jones Industrial Average Index. Most importantly, it pays its shareholders a growing dividend. Honeywell is currently trading in the mid-170s, not too far off from its 52-week low. It is down nearly 6% in the last month and down 19% over the last year. Honeywell is trading at a forward PE of 19.3. This is about 6.7% lower than its 5-year average and also about as low as it's been in the last 2 years. It's trading a little higher than the industrial sector average of 15.5. Looking at Honeywell's dividend, the current yield is 2.32%, and this is 15% above its 5-year average of 2%. This cash payout is made quarterly in the amount of $1.03 in the months of March, June, September, and December for the total annual payout of $4.12. The next ex-dividend date is November 9th, 2022, so have your shares before that date to get paid on December 2nd, 2022. That quarterly dividend is well covered by Honeywell's earnings with a 45% earnings payout ratio, and with a payout ratio like that, there is room for more dividend growth to come. Simply Safe Dividends gives us a safety score of 99, so they see this as among the safest dividends in the market. Honeywell has 11 years of consecutive dividend increases and 29 years without a cut. So they would be a dividend aristocrat if they haven't kept that dividend flat for a couple years. Like it looks like it was during the Great Recession. So overall, this looks very solid to me. The 5-year average annual dividend growth rate is 9%. Looking at their sales numbers, revenue growth has not been great. Looks like a fairly cyclical business. But they have done a solid job growing earnings per share with EPS of $4.48 in 2012, and currently the earnings per share is double that at $9.21. Honeywell does share buybacks every year, which we do like to see. Remember, when shares outstanding go up, you are getting diluted as a shareholder. But Honeywell shareholders are rewarded with a larger percentage of ownership in the business every year. Honeywell has been covered by 27 Wall Street analysts in the last 90 days, 10 rated as a strong buy, 5 rated as a buy, 12 rated as a hold. The average analyst price target is $205.42, which is about 15% upside from the current price as of the date of publishing. I don't think Honeywell is trading at a real discount per se, but it's about as cheap as we've seen it in 2 years, and you are getting a high quality company with safe and stable dividend growth. I prefer this as an option to, say, competitor 3M. Albeit you're sacrificing yield here, but Honeywell is in a much better position going forward than its troubled competitor. I think Honeywell is a solid idea from an income perspective and deserves a spot on your watch list. For stock number 2, we're talking about Lockheed Martin, ticker LMT. Lockheed Martin announced their dividend hike on September 30th, 2022 in the amount of 7.1%. Lockheed Martin Corporation is an American aerospace, arms, defense, information security, and technology corporation with interests globally. It was founded in 1995 by the merger of Lockheed Corporation with Martin Marietta and is headquartered in Maryland. It is the world's largest defense contractor by revenue, with much of its sales going to the U.S. Department of Defense, the U.S. Department of Energy, NASA, as well as foreign governments. They operate in 4 business segments: aeronautics, missiles and fire control, rotary emission systems, and space. They pay out much of their profits in the form of growing dividends. Lockheed Martin is trading around $400 and is just about halfway between its 52-week high and low. Lockheed Martin is down about 5% over the last month, but is one of the few stocks that is up over the last year, just over 14%. Lockheed Martin is trading at a 14.7 forward PE, which is slightly under its 5-year average of 15.6, and is also just under its sector average of 15.5. This suggests Lockheed Martin is slightly below or at its fair value. Let's take a look at Lockheed Martin's dividend. The dividend yield is just under 3% and is 14% higher than its 5-year average. Lockheed Martin pays a quarterly cash dividend of $3, and that is paid out for the months of March, June, September, and December for a total of $12 annually per share. The next ex-dividend date is November 30th, and if you have your shares by that date, you will get paid on December 30th. And it looks like Lockheed Martin can easily afford to pay and grow this dividend with an earnings payout ratio of 44% and a free cash flow payout ratio of 40%. Simply Safe Dividends assigns a safety score of 84, safe. Lockheed Martin has shown a solid commitment to raising their dividend with 19 years of consecutive dividend increases. Over the last 5 years, they have increased this dividend at a rate of 9% annually on average. Revenue has had a steady climb year over year since 2014 when they made $39 billion in revenue to 2021 when they made $67 billion, and we always like to see healthy revenue growth. Earnings per share have risen dramatically over the last 10 years. In 2012, the earnings per share was $8.46, and currently it is $27.40. It has more than tripled in that time frame and shows no signs of slowing down. This has been a wonderful investment over the last 10 years. Now, shares outstanding are on a steady decline, and again, this is the graph where we want to see the trend go down because that means your ownership interest increases over time. Lockheed Martin's been covered by 18 Wall Street analysts over the last 90 days. 4 rated it a strong buy, 1 rated it a buy, 12 rated it as a hold, 1 rated it as a strong sell. The average price target is $463.41, which is 15% upside from current prices. Obviously, Lockheed is in an industry that isn't going to go anywhere with very reliable clients. I don't think this is a screaming buy at these prices, but I'm adding to it by dollar cost average into our public dividend growth income portfolio. And with Lockheed Martin, I think you're getting a wonderful business at a fair price, a healthy business that has a fantastic track record of high single-digit dividend growth and share buybacks. There is a lot to like there. Company number 3 is Starbucks, ticker SBUX. Starbucks announced their dividend hike on September 28th, 2022 in the amount of 8.2%. Starbucks Corporation is an American multinational chain of coffee houses that is headquartered in Seattle, Washington. They operate over 34,000 stores in 80 countries, with about 45% of those stores located in the United States. Starbucks has had some challenges going back to the COVID pandemic of 2020 and the prolonged shutdowns in China. But things have since begun to turn around, and recently interim CEO Howard Schultz revealed the company's plan to enter their next era of growth. Starbucks sells a lot of coffee, and with those profits, they also pay a wonderful growing dividend. Starbucks is trading in the high 80s, low 90s. Its 52-week low is $68, and it was trading in that range back in May and June of 2022. Starbucks is up over the last month almost 9%. But it is still down over 20% over the last year. Starbucks is trading at a forward PE of 28.8. While this is pretty pricey, it is right in line with its 5-year average, and this definitely trades at a premium to the consumer discretionary sector as a whole at 12. Starbucks is yielding 2.35%, which is about 16% higher than its 5-year average. The stock did come down a good bit at the beginning of the year when it was in the low 100s. Starbucks pays a 53-cent dividend quarterly in the months of February, May, August, and November for a total payment of $2.12 per share. The payout ratio for Starbucks is a little high. It's 68% of earnings and 75% of free cash flow. I'm looking for them to bring this down a little bit, but the dividend is still well covered. The safety score from Simply Safe Dividends is 67. Starbucks has been paying a growing dividend for 11 years. Over the last 5 years, the dividend has grown at an average rate of 17%, which is exceptional. With this being the latest being at 8.2%, I believe high single-digit dividend raises will be the norm going forward. Revenue growth has been off the charts over the last 10 years. In 2012, they collected $13.3 billion in revenue. In the last 12 months, they've made an all-time best $32 billion in revenue, with no signs of them slowing down. There was that one rough year in 2020 due to all those shutdowns. And Starbucks earnings per share has been steadily on the rise, with the exception of that fluke year in 2020. EPS was 90 cents in 2012, and currently it is $3.13. Shares outstanding are on a steady decline. All three of these companies buy back their shares and don't dilute shareholders. And unless you're a REIT or a utility, I really prefer to see this. Starbucks has been covered by 35 Wall Street analysts in the last 90 days, 15 rated as a buy, with 9 as a strong buy, 20% rated as a hold. The average analyst price target is 97.86, which represents about 8% upside from its current price. Starbucks was perhaps a better buy back in June when it was trading in the 60s and 70s, and if you managed to build a position back then, kudos to you. I do see Starbucks as one of the top dividend companies to own over the next decade for dividend growth investors who want that sweet combination of dividend and total growth. I am a shareholder and I try to add a couple shares every quarter on dips. So like I said, I think these are all three great companies, and they may or may not be buys today. That's really up to your own goals, depending on when you're watching this video as well. But I do see these as great holds for the long-term dividend growth investor. Thanks for sticking with us, folks. If you could please like and subscribe, it would really help us out. And if you'd like to see me do an in-depth on any of these, including evaluation, let me know in the comments. Please check me out on Twitter at DivGrowthIncome and let's connect. For full disclosure, I am long on Starbucks and Lockheed Martin. Thanks again, you guys are awesome. And until next time, keep investing.